Welcome back, folks. Short little review and lecture on this past week's price action. Looking at the dollar index is our weekly chart of Dixie. You see we came down below the relative equal lows here. Sell side was taken a couple weeks ago. Market's drawn up. Originally I had some interest in both of these discount wicks, consequent encouragement, midpoint of each one of these wicks. Ended up traveling higher, and there's really nothing in here in terms of an imbalance or inefficiency. My interest resides in what would be considered the buy side liquidity above these relative equal highs, and we'll see if we get that going forward. Daily chart here, you can see now inside of that decline that took out the sell side, we had a rally up in here, fair value gap, buy side imbalance, sell side inefficiency. Trades down to it here, rallies up, and then reuses an old fair value gap. So it comes down and accumulates new long positions and trades up into the fair value gap, sell side imbalance, buy side inefficiency. These relative equal highs, I like the idea of it potentially trading up into that, but that all changes if we lose these lows and work down into the old level that was sell side defined over here. So I'm bullish on dollar presently, so I would expect some weakness on indices and continuation on Forex moving lower. 4-hour chart on dollar index. Okay, you see again working on that old daily fair value gap, trading up into the 2 down closed candles here, which is a bullish order block. Small little buy side imbalance, sell side inefficiency here. I don't have that noted because I want to keep the chart clean. We trade down into it here. So we have order block, fair value gap, trades up into, and just falls short. Notice it gets just so close to the very high of the imbalance. And again, this is defined on the daily chart. So even if you were using this inefficiency here, we still didn't get to that either. So we have a small measure of buy side liquidity here that it did in fact engage on Friday. But I'm looking for a continuation on the upside. 1-hour chart on dollar index. Again, here's that buy side imbalance, sell side efficiency, and the order block that we just showed on the 4-hour chart. And there's a little bit more detail now. So we had 1, 2, 3, 4, 5 lower lows digging into the consequent encouragement, which is the midpoint between this hourly candle's low and this hourly candle high. Split that in half, 50% of that range. That is consequent encouragement. Trades down into that 2 times and then rallies aggressively, reaching for the buy side here, buy side over here, and then almost completely closing in and repricing to the high of that inefficiency that's shaded here in pink. Moving on over to euro dollar. This is our weekly chart. And I want to count you to go back and look at the other previous weeks that I did earlier, I think in the first part of July and latter portions of May and going into June of this year. It's on the YouTube channel. I mentioned how this volume imbalance was a draw on liquidity, meaning that the price for euro dollar would want to gravitate up into that, and we did in fact see that. Look at the reaction there. You don't see that in your textbooks, do you? So the market turns on a dime, trades lower back into the old weekly inversion fair value gap. Now, I don't think this is something to be all that excited about in terms of being a buyer or turning bullish. My interest is, do we get below the weekly inversion fair value gap, this shaded area here? Do we get below that, treat it as resistance, and then dig into the sell side here, and then reprice to this discount weekly fair value gap? So I like the idea of that potentially continuation lower on euro dollar and then the continuation higher on dollar index. Daily chart euro dollar. Okay, here's that weekly volume imbalance. Look at the beautiful precision there. Small little tiny mohawk above the level here. We expect that type of deviation outside of the range that's defined for a inefficiency being repriced to. Breaks lower, creates a breakaway gap here. Market trades up to here and here, both institutional order flow entry drill. Again, institutional order flow entry drills are a trading into a fair value gap, but not even to the midpoint, which is consequent encroachment. So just a partial little entry into it, and then aggressive movement out of it. So that's institutional order flow entry drill. Trades aggressively lower, trading back down into the weekly inversion fair value gap, and then consolidation all through the month of August. Trades back up to the last up close candle here prior to this displacement, bearish order block, and then we've seen price move back down into the weekly inversion fair value gap. We have sell side residing below here and below here. Euro dollar 4-hour chart. Okay, here's that institutional order flow entry drill seen on the 4-hour chart from the daily. Market breaks aggressively lower. We have a SIBI here, sell sign of balance, buy sign of inefficiency. We reprice back up into it, consolidate in here, and then break lower, trading down into that weekly inversion fair value gap. Trade to the high of the inversion fair value gap as support here, trades back down in, swipes the sell side, then distribution to relative equal highs where buy side would be resting. Bearish order block, trades down, SIBI, but also more specifically, balanced price range. Up, down, treats it as such, and then trades down aggressively back into the weekly inversion fair value gap. My focus is over here, going forward, assuming that we continue moving higher on dollar index. Euro dollar hourly chart. Okay, again, trading up into that bearish order block. Look at all these relative equal highs here. I tweeted this earlier in the week. I mentioned that this was just too obvious. And we did, in fact, rally up into that. And once we got through the bearish order block and rejected, everything started moving lower with a higher dollar. Institutional order flow entry drill here. So we have a SIBI, one candle penetrating into that fair value gap between this candle's low, this candle's high. Small little partial entry, and then aggressive sell off, and then we have an up close candle prior to the discount range of the weekly inversion fair value gap. Trades up into that candle there. That's a bearish order block. Trades lower. Now it is consolidating. So keep your eye on this low and these lows over here to the low of the weekly inversion fair value gap, and then should we get animated to the downside, and again this is supported by a bullish dollar. If we don't see that continuation or the order flow being bullish on dollar index, it's going to be hard to do what I'm outlining here, but my intention is down here below that 108.35-ish level. All right, moving on into the weekly chart of both the E-mini S&P on the left-hand side, and on the right-hand side, it's the NASDAQ futures. Both delivery contracts are September 2023. On the left-hand side, we'll start with the S&P. So SPOOs, we had a rally up, and then we traded into an inefficiency, and we've been monitoring that. I'll counsel you to go back and look at the previous market reviews. It's all there for your enjoyment and edification. The break lower, we traded below this gap here. So this would have been normally a bullish discount fair value gap, but not once we reach a higher time frame weekly inefficiency and we see this type of breakdown. And here's the important thing, seasonal tendency. We're in the month of August, and I counseled you before we even started this month. This is the month you want to take a vacation from everything, okay? Especially if you're a trader. You don't want to push it really hard. I've done a lot of damage to myself with real money doing that type of thing. And I counsel you as my students to try to respect that measure of risk, because this is the month where it becomes very fickle. Okay, some days the market can be very easy to read, and other days it starts off like it's going to be very easy to see and watch and be a participant in it, and then it just goes wonky. So maybe, and I've noticed some people on the social medias, and it doesn't necessarily mean they're my students. I've seen other people outside of my own community that have complained about how they got beat up and chopped up this very month here. We're in August, and we're really technically not even halfway through it yet. So again, it's like a meat grinder. Okay, that's the closest analogy I can give you. There have been, in my last 30 years of being a part of the marketplace, the 30 years of experience of looking back, predominantly August is a really just a month that you want to stand aside on. Just let it do what it wants to do. If you're going to be a day trader or a short-term trader, just be very, very nimble But you certainly don't want to be trying to do a funded account challenge in the month of August. You don't want to try to do your biggest leverage type trades on the month of August because it can hurt you. And we'll talk more about that as we go. But we have the propulsion block, and I talked about this in the previous discussions over the indices, but we have a down close candle here, which is an order block, and then we have another down close candle that was eating into this one here, but only to about halfway. If we ever see half of the propulsion block, which is an order block that digs into a previous order block, you have to define half of the propulsion block. Okay, if we close below that, which we don't see that here, that would become extremely bearish. In other words, I would abandon any bullishness over here. I wouldn't look at this as a reclaimed bullish order block later on. It would be me anticipating it's going to trade lower. Now, I'm going to tip my hand to you and tell you that I think that this is going to happen anyway going into next week, that we're going to probably dig into the sell side. That's what my personal belief is, even though we did not even trade to mean threshold of this propulsion block. If you want to know more about propulsion blocks, they're in my month 4 content of the mentorship core content lessons on my YouTube channel. I'll teach you the PD array matrix where I'm teaching you basics. All right, moving on over to the weekly chart on the right hand side of the NASDAQ. This down close candle and this down close candle. I don't like this type of structure versus this over here. This is a little bit more defined, a little cleaner, meaning that the down close candle here just starts the bullish order block, then the propulsion block, which goes into essentially half of that candle, this down candle. We don't have so much of that here. It goes a little bit past midpoint of here. So when it happens to be like that, and then we have a fair value gap, these are more prone to fail. Okay, so the market trades down, digs in through it here, and also notice that the NASDAQ was a lot weaker. Now, in recent months, NASDAQ has been the outperformer on the upside, and we've been calling that before the fact anyway, but here we're starting to see signs that now NASDAQ was leading to the downside, and we'll have more details about that in recent price action. But the last up close candle here, prior to this displacement here, is a bearish order block. We've seen it trade up into that this week. 2 weeks ago's weekly low, trade up into it, and then we have power 3, which is sell side delivery, and then attacking the short-term low here on this particular trading week. We did not get that same measure of running of the sell side on the E-mini S&P. Notice that. So we're seeing a reluctance on the part of the S&P to want to go as low and as fast as NASDAQ. So that is a characteristic or signature that indicates that if you're a bear, you'd be better suited to trade short on the NASDAQ. And you've seen me doing the majority of my trades, even the live trades that I've been showing you examples of, have been in the NASDAQ. I think I've only done 1 or 2 S&P trades and showed you live account executions. So I'm looking for a run here and make it real short and sweet. I'm seeing that that is potentially the draw on liquidity going forward over the next week or 2. If we start to get animated, we have a buy side imbalance, sell side inefficiency down here. Both here and here, both are fair value gaps, but I favor the NASDAQ reaching it faster and sooner than that of the S&P on the left. Daily chart, E-mini S&P on the left-hand side. Right away, you want to take note of the SMT divergence. Okay, look at your candles, compare all the highs here versus the highs up here, how they were diverging with one another. NASDAQ was unwilling to make the higher high as we saw in the S&P. So that was that cracking correlation. Then we have an imbalance here. The market trades up into it, spends some time in that range, and then finally breaks away. This volume imbalance here and here, the volume imbalance can act much like a breakaway gap. Okay, and without stealing a lot of the thunder from the books I'm writing, I know it's a shameless plug, but there's a lot of detail that I want to save for the books, because every time I teach or present something new, everybody comes out with a course or a mentorship, and they conveniently omit me as the source where they learned it from, and you really aren't learning everything that I'm introducing briefly here. The books or the core content lessons, they have to be studied comprehensively, and then you'll have the better understand what it is I'm teaching you. But all of this is introduction in my opinion. So we have moved from the repricing of this sell side imbalance, buy side efficiency, trading up to here. The last up close candle right in here. I have that labeled as a bearish order block because I'm considering it through the lens of a lower time frame chart. So it's two things there. It's the high of this inefficiency, and it's an order block in a lower time frame. So even though don't get thrown off that this is the down close candle, the highest one, but it's supposed to be an up close candle that makes a bearish order block. On the lower time frames, that's where it would be anchored to. Market breaks lower, takes out the short-term low here. So we have a shift in market structure. Right here, this is your model 2022. Right there, bearish order block, last up close candle. So there's several factors in there. Also a breaker, high, low, higher high. Trades up into it there and breaks lower. Up close candle, while in a sell program, very, very influential in terms of price action. Mean threshold to the low and the opening price of that is going to be very, very sensitive. Study all those levels I just mentioned to you. And you can see that we traded up into it here, and an aggressive move lower, taking out the sell side there. And again, not seeing that same comparable run for the sell side on S&P on the left-hand side. We have a buy side imbalance, sell side inefficiency. This is fair value gap, which is a discount in the S&P. And it's consequent encroachment, which is half of an inefficiency or gap. Half of an order block is a mean threshold. That's what's being shown here. Notice this up close candle. Half of that's mean threshold, which is the abbreviation I have here, M period, T period. And you can see the displacement after trading into that. Here, we don't have that run up in respect of the mean threshold of this bullish candle. It's running all the way back up to where? Here is the premium wick, consequent encroachment. So half of that wick. We treat wicks just like gaps. That means its halfway point or midpoint would be considered consequent encroachment. All right, moving on into the 4-hour chart. E-mini S&P on the left-hand side. Here's that bearish order block. We trade up into it here. Also repricing to an inefficiency, which is a fair value gap in the form of a sell side imbalance, buy side inefficiency. Strong displacement lower, taking out the low, trading back up. Now look at this price action here. Okay, this is something you do not see a lot. In 30 years, I have not seen this 5 or 6 times. Okay, it's very, very uncharacteristic of a loose, very well-structured marketplace. We're seeing low, high, low, high, low, high, low, higher high, low, choppy, up getting into the levels we were looking for. This is a lot of, well, it requires nimbleness, okay? And I've watched this week a lot of social media influencers, YouTubers, traders, pseudo gurus, or whatever you want to call it. They were very, very hard pressed to want to go short. They just were saying, no, no, no. Anytime anybody would be suggesting that it's going lower or it would hold a bearish stance, they would take the position of arm wrestling them, okay, and very argumentatively or sternly presenting the opposite. So that was one of the reasons why I focused primarily being on the short side of things this week. Also, I outlined that I thought we would go lower previous week anyway. This fair value gap here, I mentioned this on a short little vignette video I put on my Twitter account. So if you're not following me on Twitter, you probably should do that because I'll give, it's like guerrilla warfare tactics. You don't know when I'm going to pop up and share something. And sometimes they're just so short in terms of time. And right there at the time, it's only beneficial if you're following me on Twitter. But after November, you won't have to worry about that because I won't be active on Twitter after November this year in 2023. So this little fair value gap here was part of that larger imbalance. And then we have the market trade, in fact, down into that today. Notice the bodies telling you the narrative, which is what I shared with this morning on Twitter. Here's your breaker. We have low, high, lower low. Take the bodies of the candle. Look at the video I shared this morning. Draw it out in time, and that's where you're seeing the narrative. It goes down, it goes through it. Where's it going? Consequent encroachment of here. This level is 4459.25. Don't take my word for it. The low on this candle is 4459 even, or 4459.00. NASDAQ on the right-hand side, bearish order block. Trade up into it here. Trade back up into mean threshold. Trade lower, You have a sell sign balance, buy sign inefficiency here. We trade back up into it. And again, this is that mean threshold. Again, looking at the daily chart, we're transposing all those daily and weekly annotations to the lower time frame so that we don't lose sight of where we are. And the market trades aggressively down into the sell side here is what I mentioned. Also in the context of that 4-hour fair value gap. So the market traded aggressively lower here, but it had a lot of give and take, back and forth. Look at all this back and forth. Okay. Now, I know some of you are going to be like, "Oh, this is one of those classic descending trading ranges." Okay, that's fine. I'll give you that. But the point is, did you trade it? Did you trade it like that? Because after the week, and you look at it like this, it's easy to say that. So what I'm doing is I'm showing you what I think is going to happen before it happens, before the chart even shows any of that market structure that would be easily identified as, oh, here it is, hindsight retail this, or it's hindsight something else. Moving on into the hourly chart on the E-mini S&P on the left-hand side, buy side here, and in the premium wick consequent encroachment, market trades up into it here, aggressively breaks lower, and then Friday we have all this back and forth price action, but digging into that 4-hour fair value gap, and again trading into that consequent encroachment of that blue shaded area here. Okay, so I want you to take a look closely. Every day, the previous day's high was taken out. So we have a run here, buy side, here, buy side, here, taken out, and moving lower. So it was preventing anyone with a short-term trader's mindset or one shot, one kill, where you get on a real nice key high and then ride it out for the rest of the week. Looking for this type of move, that's fine, but they were not permitting anyone to stay in that. And then yesterday on Thursday, we had that run up and then aggressive sell off, and then a little bit of junky price action here on Friday, but certainly tradable. 1-hour chart on the right-hand side for NASDAQ. Very similar thing here. We have a sell side balance, buy side efficiency. We trade up into it here, taking buy side. Relative equal lows, it's residing below that. That's sell side, and then market careens through that. Back up into mean threshold of the bullish order block on the higher time frame chart. Breaks lower, takes sell side, and then comes all the way back up on Thursday to blow out the high on the 9th's buy side liquidity. Then erodes and trades and creates relative equal lows, comes back up in, consequent encroachment of this wick here, sells off, fair value gap here, trades up into that, breaks lower, consolidation, and then I was opening up the commentary this morning on my Twitter feed, and I mentioned it would trade down into the 4-hour fair value gap, and I went to a very specific low and outlined the sell side liquidity. And that's what's being shown here. So I'll counsel you to go look at that as well. It dug down into that. And I wanted to go a little bit further into the fair value gap, but those were the breaks apparently. It didn't do too much lower than that. 15-minute time frame on the left-hand side, E-mini S&P. You can see how we had a rather sloppy consolidation day here. And same thing with the NASDAQ. So I'm going to close with a couple things of importance. We have a few weeks remaining for August. This is going to be probably some of the most unfavorable price action. And even if it does present something that's really clean in price delivery, and it becomes easy for you to see the setups and post me making this commentary. And I've had this happen before. Not a lot, but most of the time when I say something like, be careful, it's pretty spot on where if you listen to me, you would have spared yourself. There's been a few times where I've said things like this, and then it becomes just really nice market conditions. But that's not normal. Okay, August is one of those months where we're just getting ready to start the fall months where the market becomes really nice. September, October, November, maybe the first week, maybe the second week of December. If you're hard-pressed to want to trade around the holidays, that's one of the sweetest times of the year to trade, just like it is in the springtime. So you don't want to waste your gunpowder on the next couple weeks here in August. Just sit still, relax, let the markets do what they're going to do, and they may chop around a lot like this in the month of August. That's what I anticipate. This is the kind of stuff I was warning you about. Even though they're delivering to where I was pointing to, and every one of you as my students know that we were looking for lower prices and where we thought it was going to go to, it went to. It wasn't the easiest price action to trade with. And if you felt like it was harder, that's good that you observed that. And now you've experienced it. And with this new level of experience, you can appreciate now more what it was I was trying to warn you about. If you've caused drawdown in your account, if you have blown your account challenge, whatever it is you're trying to get a funded account, don't be in a rush to start it back up. Wait until September. Okay, just try to ignore the temptation to want to get in there right now. Traditionally, the month of August is a sloppy type of month. There's a lot of big money on the sidelines, and when that big money is not in the marketplace, you're going to get this type of action here. Can you trade it? Yes. Will you be stressed out probably trading it? Probably. Will you lose more times than you'll want to be comfortable in the other better months where your trading is a little cleaner? You're probably going to lose more. And if you're not equipped to handle that, it can be very stressful. It may cause you to be impulsive. I've done this to myself. I've done this. You've heard it many times in my lectures and in my teachings. And that's why I teach you the way I teach you, because I've done this to myself. And losing when especially if you have a historical record of seeing how it was harder for you, which you'll learn how to do that by journaling. And this is a month where you want to do most of your prep work, what your goals are going to be for the fall, going into the end of the year. Where are you in terms of your growth for this year? And try to spend more time learning and refining and how to be more organized in your annotations, your time frame management, all those types of things. This will be a good time to go through your notes about what it is you've taken from my videos. Revisit those notes. Study, but relax. When we start in September, the markets will be a lot better. There's going to be a whole lot more volatility going into September, October, November, and that's one of the best times to be part of a price action that we like to be participants in. So hopefully you found this one insightful. So I'll talk to you next time. Be safe.